Welcome to today's Explainer. We are tackling a topic that is completely dominating the financial headlines right now, but it's one that honestly gets so misunderstood. Here's the deal. This week, some of the absolute biggest companies in America are gearing up to report one of the strongest profit growth seasons we've seen in years. We're talking massive, across-the-board corporate wins. But, and this is a really big but, your paycheck? Yeah, it wasn't invited to that party. There is this stark, undeniable contrast right now between America's booming corporate profit season and the stagnant reality of everyday personal finances. And today, we're going to break down exactly why that is happening.
It's the question of the hour, isn't it? Record profits are here, so where exactly is your cut? When you open up a newspaper or you're just scrolling through your news feed, you're bombarded with these flashy headlines about a massive macroeconomic boom. But how is that boom actually impacting your own wallet? If the economy is doing so phenomenally well, why does it feel like getting ahead is literally harder than ever? We really need to set the stage here and uncover who actually benefits when the stock market cheers, because understanding this dynamic is absolutely crucial for navigating your own financial future. To make sense of all this, we're going to follow a really clear four-part roadmap today. First, we'll dive into the record profit paradox. Second, we'll figure out where all this growth is actually hiding. Third, we'll explore the wage disconnect. And finally, we'll walk through a practical playbook for your money. All right, Section 1. Let's look at the record profit paradox and the massive numbers coming out of Q2 2026. Just get a load of this number, 23.8%. Right now, the Q2 earnings season is in full swing. It kicked off in earnest around mid-July with the big banks, and S&P 500 companies are projected to post somewhere between 22.8% and 23.8% year-over-year profit growth compared to last year. And I promise you, that's not a typo. This represents multiple consecutive quarters of growth above 20%. To put that into perspective for a second, the 5-year average for the index is 16.4%, and the 10-year average is just 10.3%. We are completely blowing past historical averages right now. In fact, some analysts think the final number could approach 40% growth once every single company reports, especially following a first quarter that already came in way above expectations at nearly 29% growth. And the sheer depth of this winning streak is kind of staggering. When we really unpack Q2 2026, revenue is projected to grow over 12%. If that holds up, it would be the absolute fastest pace of quarterly revenue growth for the index since Q2 of 2022. It also marks the second consecutive quarter of double-digit revenue growth. And check out those beat rates. Of the very first S&P 500 companies to report this season, almost 9 out of 10, 88.9% to be exact, beat Wall Street's profit estimates. Nearly 8 out of 10 beat revenue estimates. So these major corporations aren't just getting by. They are logging an incredibly dominant winning streak against some really high expectations. Which brings us to Section 2. Where is all this growth actually coming from? Let's talk about sector concentration. Here is the twist. This growth is highly concentrated. It is absolutely not spread evenly across the economy. Energy and technology companies are driving almost all of the upward revisions to earnings estimates that we've seen ahead of this season. The energy sector alone saw massive upward revisions of 61.5%. Information technology was revised upward by 8.7%. But then, consider healthcare. Healthcare is actually the one sector expected to contract and shrink this quarter. Why? Well, it's largely because of expiring Affordable Care Act subsidies, which is having a direct effect on reducing procedure volumes. So right off the bat, we see that record profits is a highly localized phenomenon. It really depends on what sector you happen to be standing in. And, when we talk about the technology sector's growth, we have to talk about the elephant in the room, the big tech AI infrastructure boom. Big tech giants like Microsoft, Alphabet, Meta, Apple, and Amazon report later in July, with NVIDIA coming in late August. An incredibly huge chunk of this overall market growth story is tied directly to continued AI infrastructure spending. I mean, it literally feels like a company just has to whisper the letters A and I on an earnings call to see their stock bump up. But it means massive corporations are pouring billions upon billions of dollars into building out artificial intelligence data centers and capabilities. However, that immense concentration brings immense risk. I want to share this crucial perspective from market analyst Edward Yordini, who noted, if major AI data center spenders failed to beat the very high bar analysts have set, it could trigger a correction in tech stocks. This is vital to understand, because so much of this quarter's growth narrative rests on continued expanding AI investment. Rather than just a broad-based diversified economic strength, the market is essentially walking a tightrope. If that single concentrated area of AI investment doesn't meet those sky-high expectations, this entire record earnings narrative could face a very harsh reality check. Okay, let's pivot to Section 3, the wage disconnect, or as I like to think of it, profits versus paychecks. Let's look at the actual labor reality right now. We covered some of this data a couple of weeks ago, and it is essential context. Hiring is currently sitting near a multi-decade low. Economists have actually been calling this a low-hire, low-fire environment. On top of that, job postings have been completely flat for 6 straight months. And honestly, most concerning of all, real wages are actually falling once you account for inflation. Let that sink in for a second. Put those facts right next to the Q2 corporate earnings numbers we just talked about. Company profits are growing at some of the fastest rates in over a decade, while the very people doing the actual work behind those profits are falling behind on their own paychecks during that exact same stretch of time.
Now, this isn't a coincidence, and frankly, it isn't new. Record profits and stagnant wages can coexist for a long time, and that's because profits and wages respond to completely different economic pressures. Think about what drives profits right now: productivity gains, corporate pricing power, and heavily AI-driven capital investment. But what drives your wages? Wages respond mainly to how much competition there is for workers. When a labor market is hot, companies have to pay top dollar to attract you. But in a low-hire labor market like the one we're in right now, where hiring rates are at multi-decade lows, that labor competition needed to drive wages up is simply frozen. Profits don't just automatically flow down to wages. Wages only rise when the market forces companies to actually compete for your labor. Understanding this mechanical disconnect is the absolutely crucial first step to protecting yourself.
So what do we do about it? Let's move to Section 4, a practical playbook for your money. We've put together an essential 5-step playbook to help you navigate this 2-tiered economy. You need to drop the auto-raise assumption, advocate based on your value, understand your investment concentration, watch forward corporate guidance, and separate macro news from your personal economy. Let's break these down. The first 2 steps combine into this vital rule: base your raise on your results, not the S&P 500. As we just saw, company profits at the top of an organization and your paycheck near the bottom aren't connected nearly as tightly as the headlines would suggest. So please, do not walk into a performance review and say, well, the company had record Q2 profits, so I deserve a raise. In a low-hire market, management just isn't feeling the pressure to distribute those profits to labor. Instead, you've got to advocate for yourself based on your specific value. Document your individual results, track your personal productivity, and research the current market rate for your specific role. You have to prove why replacing you would cost them way more than just giving you the raise you're asking for. Next, if you have investments, you really must understand where your portfolio's growth is concentrated. If your retirement account or your brokerage account is invested broadly across an S&P 500 index fund, you need to realize that this concentrated energy and technology growth might actually already be working in your favor. Even if your salary isn't moving an inch, your investments might be quietly soaring because they're capturing the explosive gains of those AI infrastructure spenders. Knowing exactly where this macroeconomic growth is concentrated should really guide your future savings strategies. It helps you see where you're naturally exposed to risk and where you might need to diversify moving forward. Step 4. Watch the guidance, not just the beat. We saw earlier that nearly 90% of early reporters beat Wall Street's past profit estimates. But here is a little secret about the financial markets. Past performance is instantly priced in. What companies say about the second half of the year, their forward guidance, is what actually moves markets. Especially right now, the market is hanging on every single word about continued AI spending, plans for the rest of 2026. If you're making financial decisions tied to market conditions, or you're just trying to understand where the economy is headed, pay much closer attention to what CEOs predict for the next 6 months than to the headline story about how they beat expectations over the last 3 months. Which brings us to our final step, and honestly the most important concept I want to leave you with today. It is so incredibly easy to read broad economic headlines and just internalize them as a signal about your own life, feeling like you're doing something wrong if you aren't personally feeling the boom. But as we've explored today, a record corporate earnings season coexisting right alongside a completely frozen job market and falling real wages means we are living in a deeply fragmented system. The honest answer to how is the economy doing depends entirely on which part of it you are standing in. Separate the macro news from your personal reality, focus on your individual value, and align your investments with where the growth actually lives. So the next time you see a massive headline about a booming economy, I want you to ask yourself, is this Wall Street's victory lap or is it yours?